Welcome to this screencast. I'm Mr. Gauvin. We are going to look into using a cash flow forecast to make a business decision. And in this case study, we've got a small business operating from a van. Now, here we've got a cash flow table that I've invented, and thinking that this could be a small business, a young person like you, looking into setting their own business, doing dog grooming, operating from a van. And we've done some calculation, put them together in a table. And then right from the start, we see that even though the net cash flow by the end of the year, providing they manage to increase their sales from £1,000 a month at the start to 2,100 in the last month of the year, but the closing balance is systematically negative throughout the year. So this is not a suitable position to be in. We need to before we even start trading, we need to make some different decision. Now, as you can see here, they are thinking of renting a new van, a cheap one at £300 a month, but the first decision taken would be to instead buy a second-hand van for a one-off payment of £1,000. In addition, as they are just starting trading, they would look at relatives and friends maybe to invest in their business. In this example there would be parents putting £2,000 in order to help them get started. So you enter those revised figures into the cash flow table, and then you found that this looks pretty good actually. Okay, at the start you've got a few months with net cash flow that is negative. No doubt the fact that you had lower sales expected as you're just setting out and haven't got many clients yet, but by the end of the year you think this is going to start to become healthily positive, so let's go for the adventure of creating our own business. After a few months trading, you then review the figures. So here the business has been trading for January, February, March and April, and then you enter real figures into your table, and you realize that because the sales have been lower than expected, this obviously has got an impact on the net cash flow at the end of every month, and then the closing balance is looking a lot less positive. But more worryingly, if figures didn't match the expectation at the start of the year, and if the business isn't making the expected rate of progress to increase their sales, it is unlikely that it's going to carry on sustaining those level of sales that appear to be quite optimistic. So in fact the situation is much worse than they expected, and the business right now is at risk of failing. So after having tried to reduce their cost, they are thinking into trying to work better at increasing sales, and by investing into running some advert campaign in the local paper. Now, in addition, there's revised figures. They've realized that as the level of sales have been less than expected, the direct costs are lower. I mean, if you sell less, you don't need so much supplies of dog grooming products. So you've put those revised figures into your cash flow table. But those don't quite offset the fact that the bank is going to charge you interest for the use of the overdraft. The overdraft, yes, does incur interest, and this interest will be a cost that the business has got to bear, and that will be accounted for in the cash flow table. So after another few months of trading, so now we're into July, not quite at the end of July, and there's two things that have happened. One, really good, after running adverts in the local paper, sales level have jumped up. However, it looks like this performance in June will not quite be matched in July. There seems to be fewer phone calls asking for their service, and consequently, if they estimate that July will be 1,300, so still much better than what was happening earlier in the year. However, they are now at risk of exceeding their overdraft limit. So it's time for action again. While you stay within your agreed overdraft limit with the bank, all you have to do is to pay those interests over here. However, if you exceed the overdraft, this is likely to trigger some more severe penalty from the bank. They could even ask you to repay all the money you owe them, and you really don't want to be in that situation. So the owner of the business has decided that they should do two things. They should keep on running regular adverts in the local paper. So they may have missed the deadline for July, but right at the start of August, they are running some more adverts, and then they will repeat this operation later in the year in order to sustain the growth of sales that they've seen the first time they run those adverts. So consequently, they estimated sales to do the same pattern again. So they go up just as you run the advert, and then they drop, and then you run another advert, and then they start going up again. And in addition to this investment into publicity to increase sales revenue, they've also thought that in order to mitigate the risk of going over the overdraft limit, the owner has invested their own money. So they were paying themselves £1,000 a month. They've been working so hard at growing the business that they didn't actually spend all that money because they were not going out as much as they expected, all the hard work that's taking into their leisure time. So they can do two things: invest £500 that they've saved, didn't spend, and in addition reduce their own wage to a level that would help them to maintain a healthier cash flow for the business. So you enter all these figures, and then you find that at the end of the year, the last few months of the year, the net cash flow is definitely positive, so it's a really good situation to be in. The business is still going to finish with a negative balance. The end of year closing balance is going to be negative. However, if you think in terms of providing an analysis or an evaluation in a 9 or 12 mark question for your GCSE, from these figures you could make the point that if the owner of a business had made those decisions right from the start of paying themselves a bit less, together with right from the first month running some adverts in the local paper. Now, in this table, I've only updated those costs. I did not touch the sales level, which are the same one that they predicted right at the start. And you can see that if you put this data together, the balance, a closing balance, is reasonably all right. This is within reasonable operating limits for a small business like that, which would have a special package from the bank that will include an overdraft. Banks are quite keen to help young people start their own business. The one thing I did not do, though, is to amend the predicted sales figures, because what we saw in these reviews, we saw that this being meant to be real figures, as soon as you run an advert campaign, you see a sharp increase in sales, followed by a small drop, but the drop doesn't drop below the figures prior to running the advert. So if you have a similar pattern of increase in sale, you should be able to easily meet those predicted figures and quite likely to exceed them if the increase is as sharp as what we saw in the review figures. So all these points are elements that you could bring forward and you could write about if you had to if you was asked to evaluate or analyze a case study like this one in your GCSE. I look forward to reading your explanations when you're going to apply this into some more example of small businesses that I will invent for you in our lessons. Thank you.